I think cutting my presentation to 7 minutes will be very risky, but I will try. Are we on? Okay, it's working. The thing is, I have never seen in so many years anybody talking about risk, price risk management. So I thought, let me take the risk of talking about risk, and the time is never been more apt than this hugely volatile markets. In Dubai Globoil, when I made a presentation about the volatile markets, I thought that we had bulls and bears, and then we had a kangaroo markets, and then I said that like a dolphin, probably you can make a wave and try to make and ride the markets, but little did I know that there is a tiger in the offing, the market, and I'm reminded of life of a pie, which is like a trader, and Rashid John Mohammed said, when everything is clear, nothing is clear, but when nothing is clear, remember, you are facing a tiger every day. Okay, some of you can connect with that. Quickly, why are we talking about the risk? One, extremely volatile markets, uncertain macro factors, complexity of interrelated commodities, ambiguity of government policies. But the impact is huge because many times this risk is impacting your cash flows, your margins. It can affect your farm realizations. It can affect the consumer inflation and thereby, a concern point to the government. It can be supply chain risk that we faced. And also, as you know, this sector, 1.5 lakh crore industry is so huge that it can affect the feed industry and the aqua industry, and we have seen it in action. Now, little bit of analytics here. These are the price movement that we have seen of 3 major oils. And the take home is that when you gain the market during the rally time, the gain was in terms of measurement something like 0.4% per day. But when you lost money, if at all, from the peak, it was, as you can see, double, which means every dollar that you earn is coming at twice the risk of the previous period. In less than a week, the risk has doubled in the marketplace. I think I've been speaking to many experts, many friends, and the colleagues, all the big players. I think everybody says the risk was extremely difficult to handle, and thereby it made me think, despite all our experience of 30 years, in case we have to analyze what is the problem in the market, I thought it will be worthwhile to share a few things of the 3 oils about the risk management of it, which I'll come in a minute. What was the cause of the volatility that we have never seen before? I think you have seen palm oil markets have moved 1,000 ringgits sometimes in a 6 months time. But we went through a period where it went in a day. That kind of a movement that has happened, making your purchase and hedging and the sales and the downstream sales extremely risky. What was the cause? An example is that of Indonesia, because consistently when the DMO, DPO regulations changed, the market reacted in a very, very different way. And at some stage, combined with the duties in Indonesia, the price of palm oil became almost same as soybean oil. I remember it was as high as sun oil. We had all kind of complication in the Indian market. For example, mustard oil was cheaper than palm oil at some stage. So these are the fundamental risky elements of the policy. But now it seems like the market is somewhat stabilizing, and within 45 days you have seen Indonesian policy moving from consumer driven orientation to farm driven. From an export ban, very quickly it moved to export acceleration program. These kind of things coupled with Indian duties, for example, in the month of October, fell suddenly by 17%. So that also changes your risk reward equation completely. And I speak to all of you. Many of you say it was real, right? Then just want to show a couple of things in the next 3 slides. We had a period of what you call value at risk. When the time during October to March period, when it was a good time, you were able to make money. But then the risk reward was extremely different. The value at risk during that period compared to the period of April to July, because of the volatility, every dollar came at double the risk. And that's what I mean by the challenge in the risk management. Now, there are 2 types of market structure. This is for my friends, disciplined players here who hedge their commodity. What kind of a risk you saw? During the period on this left side where the market is deeply inverted, as in Indian refineries, you have to buy oil at the spot, paying $100 more. But when you want to hedge it, the inverse makes it very difficult when Indian market doesn't pay for it. But you have gone through that. Many refineries got saved because of the rally. So the rally became a protection against your hedge risk. But when you look at the current carry market structure, wherein you see that the nearby is depressed, but the forward market is at a carry, it's fine because you will buy the nearby and you can use the hedging tools to sell the forward markets. So, but this makes it an interesting challenge on a hindsight to see how you would actually hedge your price risk when you buy palm oil. This is a single most hot topic with all the suppliers dealing with soya and all the buyers dealing with soya oil, including my colleagues here from Adani, Ruchi. Whoever is buying bean oil, the traditional way in the last 10 years is to use Chicago Board of Trade as an hedge. But what happened in the period of this, and increasingly here, it's become more divergent, which means that I hear this from all the suppliers I met in the last few days. The K movement has happened. Chicago Board of Trade is independently operating. It's an island because they don't nearly export any oil to India, and they also don't import much of a palm oil. I mean, 1 million tons, 1,000,002. So that creates a kind of island situation. So what is the tool? How do you hedge the basis risk? Today, if you see, the farmer selling is huge. The Chicago keeps rallying. The flat price doesn't change. The correlation that gone for a toss asks you to review your traditional methods of hedging. FOB paper can be one of the options if you are able to access covering your basis risk. The Indian physical prices, but also in rest of the world. So one thing that comes to my mind here for the trade bodies and the big players, I think there is a need to make our domestic exchanges happen, because the risk for us when you convert a dollar inventory into rupee is here, it is in India. So we need a robust Indian exchanges to take care of this for sure. That is definitely our recommendation to the government as part of IVPA to say you need to get the exchanges back. Look at China. China doesn't have this problem because I'm told that they don't need to use Chicago Board of Trade for oil hedges anymore because there is a huge Dalian market which protects the price risk from debacles. And quickly here, sun oil, my friend here from Russia, we heard him speaking about the Russian sun oil dynamics. But the issue is, look at the price movement from a risk point of view. we had a huge rally, and whenever there is a rally, the Indian market does not catch up. And today, the international prices have fallen very badly. The green line shows the Indian, the blue line shows the Indian price stable in Chennai South, for example. So this can create a huge MTM swings. It is not for the faint-hearted, because the market moved in all the products by $2,000 from sun oil from $2,000 to $1,300, and you saw palm and soy also in the similar range of. And one of the issues here is anybody can buy palm oil, you can refine it, you can brand it, you can sell it, but what you cannot do is you cannot hedge it. So you need to find new innovative ways of handling risk, definitely, for these products. India being the largest player, definitely we need to sort out. We can look up this later, but when I look at soft oils, the total demand supply, the blue line on the end of it, 22-23, is more or less a little bit matching. So in case of soft oil, I don't think we have any big surprises. Malaysia, Indonesia, we expect the production to be 18.5 million tons for Malaysia. Indonesia can be about 48.2. The issue is in the rightmost bottom corner of the price. It's only a few months away, October, November, December. You will hit a price of the overall carryout stocks of 10.6 million tons, which we have not seen in the last few years. And one of the things that has happened is that in the palm complex, you started having alternative supplies from Thailand, from Papua New Guinea. But in terms of risk management tool, I think it works well now to be able to hedge in the international exchanges. If the liquidity in domestic exchanges improves, all the more better. There are macroeconomic factors which are influencing your risk. Any trader in any company today has to be watching. Definitely the US inflation. The US Fed is now seeing interest rates going up. Other major central banks also tightening the policy. Dollar strength is likely to continue for a while. Brent crude and veg oil is nearly very correlated. I was just having a friendly chat with James Fry. He was suggesting, would you hedge gas oil against your palm oil if they are so correlated? As far as I know, he is the most, the largest, biggest possible expert in the study of gas and CPO correlation, something from a risk management to think about. And then you have inflationary pressures on the global growth. PMI indicators are weakening for advanced economies. China is showing signs of recovery. This is the good news, with the things slightly improving both on the industrial production and the COVID cases. This I wouldn't spend much time. I think it's obviously clear that we need a very good risk management system within India, hedging avenue for all stakeholders. Liquidity has to improve. We need to focus on farmers soon. I think we as IVPA often meet the government. One of the concerns has been the high prices. In fact, we have said we can't keep moving from consumer to farmer quickly. We have to learn from other countries where the swing is happening very quickly. So as far as we are concerned, as IVPA and our members, we recommend a dynamic, transparent duty slab system wherein the duties of India can protect either the farmers or the consumers automatically with a predetermined calculation which shows how to move the duties linked to the global prices. Nevertheless, not lose the MSP concept that we have in terms of growing domestic oil seeds. But this is very important in the long run to have our own risk management, because in the rest of the world, the risk management tools are failing. As India, being an importer of 14-15 million tons, cannot afford to have that kind of a risk exposure for the players if the industry has to grow. Then the S&D, we've spoken about some of the technical factors, some of the S&D coming back to closer home in India, I think we have seen a steady growth of domestic production. If I have to take a risk, assuming what we know of the Kharif crops, Rabi crop of mustard being open, tentatively we can expect domestic production to be about 11.83 and imports to be 14 million tons. I expect out of which 8 million tons to be palm oil, 3.6 to be soya, 2.25 to be sun oil, because the prices, as you could see, have readjusted back to its original level, wherein CPO is cheaper, sun oil is competitive versus bean oil, and probably bean oil has got itself outpriced a little bit, so palm will regain the market share. Good news for MPOC, good news for Indonesia. So we will definitely continue to buy palm. One of the things to remind, I think it has never been more important to have a risk management framework constituted by like risk identification. We need to assume that risk, and as per our need, as per our ability, we need to appetite, we need to define the risk limits. These are dangerous times, you have seen it. Remember the tiger on the slide too? So you need to have right hedging tools, exposure, proper reports, risk management governance, risk operating model, and limits and alerts and all that stuff. That's all I can say, having handled risk for over 25 years. We need to strengthen and get more involved. And I hear from most of the companies, one of the largest topics on day-to-day is definitely risk on day-to-day basis when you have your morning meetings. Very important because it constitutes a large percentage of your bottom line. Last, palm production summary is what I just said. India's domestic consumption, after seeing 7 to 8% drop due to very high prices, I expect it to grow a little bit to 2.5% this year. Imports we already spoken about. Price outlook, I can't stop myself from giving a price outlook, though it is dangerously risky. But then expect the CPO C&F prices to be $900 to $1,000 during this OND period, and probably $1,000 to $1,150, $1,200 in JFM. Can be more if the bean oil prices remain where they are. So then palm will get supported because it makes sense into the biofuel today. Assuming crude oil prices don't have a huge surprise, I would like to keep talking to James Fry every day on that. Soya C&F India can be in the range of $1,200 to $1,350 because of the reasons that I said. Bean oil does not need so badly the world markets, and farmers are capable of selling gradually and slowly. And sun oil C&F is good to have competition between Ukraine and Russia. Like the competition between Indonesia and Malaysia, let the market decide what the price is. But if you look at the supply situation of locked up sunseed in Ukraine, I think sun oil will try to compete with bean oil and probably eventually inch a little bit higher to gain consumption. But in a nutshell, I think today palm market needs the world market and the Indian market all the more than ever. Happy trading, manage your risk well, good times. If you take care of, I'm telling myself, if you take care of the downside, the upside will take care of itself. Thank you very much.